All right, what is up, traders? What's up, tycoons? Super excited for today's video. Lots to cover in today's video. We're going to go over food prices. We've got to talk about the bond market, okay? And this has been the largest sell-off in history. We're going to break that down, go over what's so different this time than what's happened in the past, and really break that down for you guys so you can understand. We'll talk about some historical performance and relationship, and then we'll talk about the massive money flowing into bond ETFs. All right, we'll also break down, the difference between the S&P 500 dividend yield and the 10-year Treasury yield. We'll talk about GDP, share of income earned, and break down why that's important in today's video. We're also going to talk about the SPX. This is your S&P 500. We'll go over a 1-hour chart, a little bit of a smaller time frame. Then we'll break down a daily chart scenario, and this is going to be a little bit more of a bearish scenario here. And then we have a bullish scenario here. So this way you guys can see how things progress in the market and be prepared for whatever comes next, right? You don't want to be caught off guard. You want to be open-minded to both scenarios. So this way you can see how things progress. Now, as always, the content provided on this channel is for informational and educational purposes only, and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the full disclaimer. If you're new to the channel, you don't know, I started a completely free newsletter for y'all. It's called Investment Intelligence. There's a link in the description to join. Completely free to you guys, giving out free, valuable finance content, and also giving out free trade ideas. I try to sprinkle in some free trade ideas. This was one on Tesla, talking about some of the conditions we're looking for. That trade turned out very nicely, played out very well. This was a short position on SWK, Stanley Black & Decker, highlighting the rising wedge, looking for, what targets we thought the price could come down to. That played out perfectly here as well. So if you're fans of free, valuable content as well as free trade ideas, sign up for that newsletter so you can get those trade ideas straight to your inbox. And if you guys are ever interested in, one-on-one sessions, right? These are some of the returns from some trades here recently. Hundreds of % trading options. If you guys ever want to do a one-on-one session with me, you can do a 30-minute or 1-hour session using the link in the description to go to my Ko-Fi page, right? You just simply click on the commissions here, and that is the platform I'm using now to book all of the training sessions and personal sessions. I do those every single week, and we can work on scheduling a time together that works well for both of us. You can also use the Ko-Fi page to request a YouTube video. If you want a video made on a specific topic of your choice, I'll be happy to do that for you. Ko-Fi is the platform to reach out to me directly. Now, the global food index steadies in September. So we've seen a nice decline. All right, and it's steadily declining. Remember, do you guys remember eggflation? Okay, the massive increase in the price of eggs and just food in general. We saw a massive spike in that, and we've seen a very steady decline. So that's been something nice to see, and good. That's a little bit of good news when it comes to inflation. I know the latest CPI and PPI reports came in hot, but that was largely expected due to the massive push up in energy prices that we've seen here recently. Now, the greatest treasury bear market of all time, multi-year long bear market, guys, from 2020 to today, right? We're literally living through the worst bond market bear market ever. Okay. And people don't realize this. They really don't. I mean, look at this. This is your BND ETF. So this is the Vanguard Total Bond Market ETF. So going over multiple durations and, just giving you an idea of the general sense. Making all-time lows. Okay, not only is it making all-time lows, but look at the pace of this sell-off, guys. All right, so this is 2020, and for 3 years now we've been stuck in this absolutely brutal bear market. When is this bear market going to come to an end? We have no idea. You have to be so cautious trying to play the bond market and trying to time the market, right? There's a difference between trading and then being the person that's going to call the bottom and go all in, right? Imagine the people who went all in on the bond market here. Imagine the people who went all in on the bond market here. Those people are underwater right now, or simply trying to time the market. And if they didn't have a proper plan, most likely they panic sold for a large loss, or they're sitting on some big and significant paper losses. So, Now that we've created new lows, it's very possible that the bond market could see a little bit of a short squeeze. Okay, there's massive amounts of treasury shorts and short positions in U.S. treasuries, but you have to also keep in mind that there are bear market rallies. All right, and we could see a significant move to the upside, and you just want to be careful, right? I'm not saying it has to be a bear market rally. The bond market could get out of its bear market and try to start a new bull market, but you want to be cautious of these things. Now, normally at the end of Fed tightening cycles, bonds rally. This time has been different. Investors had priced in and are now pricing out a recession with a quick turn towards rate cuts. And so what we're seeing here is the 10-year treasury yields from 6 months before to 12 months after a Fed rate hike increase. And so the black is basically where we are now. And what we're seeing is treasury yields are actually still continuing to climb. This is resulting in bond ETFs going down, okay? Because as yields go higher, the price of the bonds go down. And you can see in the past, okay, treasury yields have actually started to decline. All right. And talking about the 10-year treasury yield, the TNX is the most commonly looked at one. It started to decline typically. And that's just not what we're seeing, right? We're seeing a totally different environment. We're living through the largest sell-off in bond market history, the worst bond bear market ever. And you're going to be able to tell your children and your grandchildren about it, that you were a part of it and you were there for that. Now, long-term government bond performance. This is basically just another way to look at how historic, the times are that we've been living in. When the Fed has gone on a pause, typically you start to see bonds start to go up. This is the bond performance for long-term government bonds during pauses. And you can see in all the other time periods here, it's gone up. Well, this is where we're at right now. The Fed has already paused before, but bonds keep selling off unlike any previous pause. Okay, so again, just living through really extraordinary times right now. If you look at the worst 100 days of stock returns and then the bond performance, pre-1998, bonds were down 65 out of 100 of the worst equity days. But post-1998, bonds were down only 17 out of the worst 100 equity days. And that's post 1998. But now we're seeing a crazy different time, right? And, we're seeing this massive sell off in the bond market. The stock market got out of its bear market and started a new bull market. But the bond market is still in its massive bear market. Now, even with all of that being said that I've explained, the Fed fight has transformed bond ETFs into cash incinerators. Okay, what do we mean by that? Well, TLT has come out of nowhere to hit number 3 on the top 20 cash burning ETF list. All right, with over $10 billion lost. This is the top of list. Used to be negative 2x, 3x, the VIX, commodity ETFs. Now it's vanilla bond ETFs, right? Literally, we're seeing BND. That's the Vanguard Total Bond Market ETF we looked at. And then you have iShares Core US Aggregate Bond ETF, the AGG. And then you have TLT. And look what's right below there, ARK-K. So you literally have, bond ETFs up here, outpacing things like ARK-K, which are high risk innovation ETFs that often see large drawdowns as well as large gains, depending on the market environments. And it's just absolutely insane to see bonds up here. So they're getting massive amounts of inflows. If we take a look here, this is the TLT. So this is the price of TLT, and then this is inflows. All right. And we're seeing, billions and billions of dollars pile into TLT as the price of TLT has just dramatically been crashing, right? The beginning of this is 2020, but you can see here really in March of 2022 is when we saw a major increase in the, bond inflows. And that is when we also saw the major decrease in the price. So this is something extremely rare, right? You're never going to see this necessarily in, if this was Tesla stock, let's just say, if Tesla stock was dropping this much, you would not be seeing massive amounts of inflows and inflows just exponentially increasing, right? It went from 5 billion in March up to 35 billion now here, almost a year later or over a year later. It's just absolutely insane. That's a huge increase in the amount of inflows that we're seeing. And there's a few reasons for this. Okay. One thing you have to keep in mind. So if someone wants to short US treasuries, what is a way that they can do that? Well, they can do that via the TLT. So, TLT has been a very good short trade. if people are coming in here and wanting to place bets, they're going to, in a sense, be putting in inflows to the TLT ETF. So you have to keep in mind that, as we see this going up, yes, there's a few groups of people that are contributing to this. So one of them is going to be shorts. Okay. Another is going to be people saying that this is the bottom. The Fed is going to start cutting rates, and that happened over here. A lot of people thought that the Fed was going to be done, start pausing, and they've actually continued to raise rates more. And now that they've started to pause, people are saying, okay, well, they're not going to raise rates anymore. We're done with the rate hikes again. And they think that the Fed is going to start cutting here soon. So those are your two groups of people. The third group of people is going to be people who are essentially just using this as a hedge. Okay. And what I mean by that is if a recession is coming, okay, in a sense, the treasury yields should start to drop and the Fed should start to cut rates. And if those things do happen, then you would see the price of something like TLT go up. So you have, a few different groups of people in there just contributing to this massive increase, right? If you've been long the stock market, it makes a lot of sense to have a little bit of TLT in your portfolio as a hedge for a possible recession or something like that. The 60/40 portfolio got absolutely crushed in 2022. And now, if you're not familiar with the 60/40, that's basically 60% stocks, 40% bonds. Now bond yields are actually attractive again. They've been at levels that we haven't seen in an extremely long time. And so, now you have a lot of people actually going back to the 64 portfolio. Maybe in the prior years before this, maybe they were more of a 70/30, right? 70% stocks, 30% bonds, or maybe even 80% stocks, 20% bonds. And so those are the things that you have to keep in mind. Now, when you look at the difference between the S&P 500 dividend yield and the 10-year treasury yield, it's at its lowest level since 2007. What happened right after 2007? Well, we all know the great financial crisis. So this is something that's spooking a lot of people in the markets. And this is something that the bears are going to show you, and the bears are going to point out as a major cause of concern to equity investors. Now, GDP growth has declined since the 60s. All right, this is your year-over-year change in real GDP from the Game of Trades. We also have the shares of income earned. So when you look at the share of U.S. national income earned by the bottom 50% and the top 1%, you can see that the top 1% here in blue has just continued to rise since 1978, as the bottom 50% has just continued to decline. So we're just seeing this huge wealth inequality, and the Fed is just making this wealth inequality even larger because, the extreme rich, the top 1%, what do they have a lot of right now? Well, they have a lot of cash, right? There was lots of stimulus, there was lots of loans, government loans, and different things like this, basically just free money. We're in a free money environment for a long time, and the top 1% had all of this money. And now what they can do is they can take this cash that they have, that they've accumulated, in that free money environment, and now they can actually get really attractive short-term treasury bills. Okay, they can get short-term T-bills getting a very significant return due to the inverted yield curve, with short-term treasuries, short-term treasury maturities actually paying a higher yield than long-term treasury maturities. So they can come in there and yield farm essentially risk-free, of course, given that the US government doesn't default on its debt. But a lot of people don't think that'll happen. Some people think it may. The debt ceiling in U.S. national debt is definitely a topic for a different video that I've covered in some previous videos. And when you take a look at the shares of income earned by the bottom 50% and top 1%, that's essentially what we're covering, right? In the last slide here. But again, if you just take a look, this is the top 1% just by itself. It's just steadily rising, guys, just steadily getting higher. And the top 1% are just making more and more, a higher percentage of the U.S. national income. It's above 20% now. So 1% of people in the U.S. are making over 20% of the U.S. national income. Now, this is the home price to median household income and the ratio of home prices to median household income. So if you take a look, basically your average person now needs to make 7.5 times, their household income to be able to afford a house. I mean, this is just an ugly trend, right? This is not a trend that you guys want to see. Okay, you want to see this actually stay. I mean, if you look pre-1975, you only had to make about 3.7 times your income to be able to afford a home, right? For the home prices, we saw a massive surge in '07, okay? And we're way extended beyond that. We're much, much higher. You know, things cooled off after that into the early 2010s. And we saw it come down below five times, but now it's back up extended and heading towards 7.5 times. You know, meaning basically, you know, a house is going to cost you 7 times you know, basically your household income. So not very good. Now let's get into some technical analysis here. What we're going to take a look at first is going to be our SPX 1 hour chart. So S&P 500. We're going to break this down real quick for you guys and show you guys, you know, one thing that we're looking at. So, you know, one thing that I'm looking at in particular is going to be this potential head and shoulders pattern with the left shoulder here, then a head. And then if we get some type of price action that looks like this and follows this, that would essentially put in a right shoulder here. Okay, so you know you kind of have this double top head and shoulders potentially forming here. This is something I'm going to monitor and see how it progresses. You know, I'm not short or long really the S&P 500 right now, just kind of watching things. You see a lot of action with our anchored VWAPs here. This is the purple lines, and they're all slightly starting to tick down, right? You know, these are all starting to slightly tick down, except for our monthly anchored VWAP anchored to the beginning of October. That's still in an uptrend. It's starting to flatten out a little bit. If we lose this anchored VWAP here, right around 4,300, then I think it's very possible we come back down to 42.68. So, you know, we'll basically just call that 42.70. Now, we do have a little bit of a selling channel here, right? A little bit of an algorithmic channel. We'll see if we maintain the selling channel, the selling structure as we continue to develop. And if we do, you know, that's another thing that kind of would align a little bit with this head and shoulders. We progress a little bit lower, get a nice little bounce up. 43.41 is going to be a key resistance level now. You can see we were able to flip that to support over here, flip that to support over here. And once we finally broke through there, we saw a pretty significant move to the downside. And you know, we'll just have to monitor how this progresses. So you know, if you're bullish, you're going to want to see a breakout, retest, reclaim of 43.41 as support on the S&P 500 index. If we can do that, we have a gap up here to fill around 4,400, with 43.80 being the major resistance overhead. We were not able to fill that gap, right? You can see we actually put in a double top here, broke through that neckline, and we've continued to progress lower really ever since then. If we zoom out and take a look at a daily time frame here, this is going to be your bearish scenario. So the first thing we're going to cover is a bearish scenario, where instead of an ABC correction to potentially go higher, rather we're setting up for a 5-wave structure to the downside that's going to be more impulsive and more bearish. So we'd have a 1, 2, 3 down, this being wave 4, and then wave 5 could potentially take the S&P 500 down to 4,100, which is also right around where we have a gap to fill. Okay, there's also a gap to fill right around 4,100. So we'll see how that, you know, monitors and progresses. We've got a very clear downtrend here on the daily time frame, making a high, making a lower high, making a lower high. We've got a low, making a lower low. So for this downtrend to change, we'll need to put in a higher low, and then we'll need to start putting in a higher high. For now, you know, it seems we put in our next lower high in this chapter. And as I mentioned, the anchored VWAPs are, you know, not looking great. We only have one that's really in an uptrend right now. So we'll have to see if this can hold as a support level and help to maintain, you know, support and buyers in here and help to create an uptrend with higher lows and higher highs. But this is going to be your bearish scenario right here. Okay. Is, you know, we end up breaking through these levels, that this bounce was simply a dead cat bounce for wave 4, and that we're going to possibly continue heading lower for wave 5 down to the 4,100 area. Now, your bullish scenario is that rather than getting in a 5-wave structure, what we got was a simple ABC correction. So we had an A down, B up, C down, okay? And a ABC is a corrective pattern, and you would look for the trend to continue. And so in this case, we had a bearish correction here, and then we're getting a bullish impulsive move to the upside. And if that's the scenario, I think that the S&P 500 is going to come back up to the 4,800 region. Okay, you know, these two trend lines right here, they indicate a bullish chart pattern known as an inverse bump and run pattern. We got a very strong breakout through the first trend line, and then next we would look for our breakthrough the second trend line here to take us up to the original, you know, to the top of where the pattern began, and that would be, in my opinion, a wave 3 target area. right above there, and then we would look for a wave 4 pullback, and then wave 5 would take us up to that 4,800 region towards the end of the year. I've done a lot of seasonality things, and seasonality suggests that we are going to have a strong end of year rally. And so that would favor this bullish scenario a little bit more. The thing we have to pay attention to more is going to be short term, right? Are we just getting a wave 2 correction here, or is this going to extend lower and possibly give us that wave 5 that we were talking about to the downside and try to create new lows and continue this downtrend? So that's what you want to monitor right now. You don't have to force any decisions. Remember, cash is a position. You don't always need to feel the need to force the trade, always be long, always be short. And if you're constantly changing your theory on the market, every day or every other day, saying, oh, we're going to all-time highs, oh, we're actually going to revisit October lows, then you need to reevaluate some of the strategies that you're looking at to analyze the market, because that's not healthy and that's not sustainable. And most likely you're going to blow up an account trying to invest or trade like that. Now, thank you guys for watching the video. Don't forget to sign up for that newsletter, Investment Intelligence, giving out free trade ideas and free valuable finance content using the link in the description. And if you are interested in learning how we do trades like this, and how some of these returns are actually possible, go ahead and hit me up on my Ko-Fi page. Okay, use the link in the description to go to Ko-Fi, and book a 30-minute or 1-hour session on there, and we can go over some of the different strategies that I use. Or if you have anything specific you would like to go over in our personal session, just feel free to let me know, so that way I can put something together for you exactly tailored to your needs and your request. Thanks again for watching the video. Smash the like button, subscribe for more.